Well, welcome to financial market failure. As you can see, there are quite a number of failures, so let's get started. One of the most significant market failures is that of moral hazard. And a moral hazard is any situation which one person makes the decision about how much risk to take, while someone else bears the cost if things go wrong, if things go badly. A very good example, a simple example, is insurance. If you take out insurance for your car, are you going to drive more recklessly? If you take out health insurance, are you going to live more recklessly? Because only you know how recklessly you're living. The insurance company doesn't. Bike insurance. I've lost many bikes that people have stolen, and maybe if you have bike insurance, you'd be even less careful. So you just leave your bike. If it gets stolen, it's not a problem. It's paid for by the insurance company. And that's a clear example of moral hazard because it changes the behaviour. The behaviour becomes more risk-taking. And a good example of this, it doesn't only refer to individuals, it also refers to whole banks. And the bank bailouts, which have occurred over the decades, over the centuries, have perhaps encouraged banks, such as the Royal Bank of Scotland, to take excessive risk because they know if they get into difficulty, they'll be bailed out by the government or helped by the Bank of England as a lender of last resort, and that encourages them again to repeatedly take excessive risks. If the bailout wasn't going to occur, then they'd be more cautious and more prudent. So this is a pretty good example because we need to rescue banks such as the Royal Bank of Scotland because they provide huge number of retail bank accounts for firms and for individuals, hence the reason for bank bailouts. But it does lead to a problem of moral hazard. One way around this, of course, is people pay insurance premiums. So if your bike gets stolen, you have to pay the first £100, or your car is in a crash, you have to pay the first £100, say, to have it fixed. Okay, another big area that is connected is that of asymmetric information, and this is when one party has more information than another. So this is a good definition is where one individual or party has more information than another individual or party and uses it to exploit their situation of the other person or party. A good example of this might be subprime mortgages, so that in the early 2000s, ninja mortgages were actually sold to many individuals. Now these were mortgages where people have no income, no job, and no assets. Usually quite a scary prospect for a mortgage firm. But what happened is the only people who really know how risky these were the actual mortgage companies themselves, because what happened was the mortgages were all packaged together. So imagine each bit of paper is a mortgage. These are all good mortgages, and we've got one dodgy mortgage in there. So we put the dodgy mortgage, which has got a lower credit rating because it's for the ninjas, and we put that with lots of very good AAA rated mortgages. Put them together, make it a really complex financial product, sell it to a bank, they might sell it to another bank, and it passes on. And these products are often called collateralized debt obligations, and the process of packaging mortgages together is an example of securitization, and you sell it on to other banks. Now, what happened eventually is, of course, these ninjas could not afford to pay their mortgages, so they defaulted on their mortgages. Then, the bad bit, this is worth nothing. But because it's all bound up in a whole collateralized debt obligation, no one really knows how much this asset's worth and how bad it is. Especially as the contracts are incredibly complex and no one fully understood them, apart from perhaps the people that made them in the first place. Another example of asymmetric information. So banks were then left after 2008, when there was a subprime defaults occurring, with lots of toxic debt on their balance sheets, and they've been trying to deal with this ever since. Perhaps another simpler example of asymmetric information is when banks encourage traders perhaps to take excessive risks, because the trader makes a lot of their income in big bonuses. And these bonuses are based on short-term profits. So you could rack up big risks and big profits potentially, and then take your big bonus, then leave the bank, bye-bye, and then you go to another bank and do the same thing, then maybe another. Meanwhile, in the first bank, your investments have gone very badly, and the bank ends up making losses. But only you know the risks that you're taking. An example of this might be Nick Leeson. So Nick Leeson was a derivatives broker that worked for Barings, and he took on unauthorised speculative trading to try and cover up previous mistakes. And the people at the top didn't really know what he was doing. Maybe he was covering it up, but the bank systems didn't find this out until it was too late, and the whole of Barings Bank collapsed. One of Britain's oldest investment banks. And that's a slightly dodgy example of asymmetric information. Perhaps the biggest and the worst and most significant example in recent years has been the PPI scandal. PPI stands for Payment Protection Insurance. So say you go along to your bank and say, hello, I would like a loan. And so they give you a loan and they say, excuse me, I think you should have a bit of insurance, just in case you become ill, become unemployed, and you can't afford to meet the repayments on the loan. So they sell you this insurance that you don't really need, but you don't really want, and for far too much, for a big multiple as to what you could actually get it on the open market. And this mis-selling of a financial product to people that don't really need it took place on a massive scale. 12 million was sold, and the banks are having to pay out around about 22 billion in compensation, and that is so far. This is ongoing, and we're talking early 2017 at the moment. But why is this asymmetric information? Because the bank is selling you a product which you do not know everything about, but they do. You don't know that you don't really need it, you don't know the fine print, but the bank does, so it can take advantage of that, and of course it can charge more. They gave the impression that to get the loan you needed to take out the PPI. Very dodgy, okay? And the banks are still recovering from this. So we've done moral hazard, asymmetric information. Perhaps one of the biggest problems of financial markets is the occurrence of speculative bubbles, okay? Now speculation is rife within the city, within financial markets, across the world, and has been since financial markets were established. And all speculation means is the perfectly innocent activity of engaging in risky financial transactions to profit from short-term fluctuations in the market value of anything really. It could be houses, or the property market. That's tricky because it takes a while to buy and sell houses normally. Could be exchange rates, could be shares, could be bonds, okay? It could be commodities such as oil, or food commodities such as coffee. Anyhow, a speculative bubble forms according to the definition when an asset is traded at a price significantly above its intrinsic value. We might call it fair value. How you work out its fair value and its intrinsic value is tricky, but often it's a value that relates to, say, the profitability of the share, of a rental value of a house, of a coupon, the return on a bond. Judging when the speculative bubble is occurring is a little tricky, and hindsight is a great thing, isn't it? So, and people tend to think, a bubble has occurred after the crash occurs, such as in 1929, in the share market in Wall Street. So basically you get this herding behaviour, and it's an extraordinary human behaviour worth looking up psychologically, where people see a price going up and up and up and think, oh, I must have a bit of that. So that happened in the South Sea Bubble in the 1700s. So Isaac Newton bought shares in the East India Club. Then it went up and up and up, and he thought, oh, it's doing quite well, I'll sell them. So he sold them, and it continued going up, and his friends were still buying them. So he then got back into the market, bought more shares, and then what happens, of course, is you get such a high value. Normally something happens such as an increase in interest rates, for example, set off the credit crunch in 2008 when the ninjas started defaulting on their mortgages. House prices began to fall. So the market then turns and everyone panics, and suddenly they sell their assets very quickly, and then you get a huge crash occurring very quickly. And this is characteristic of financial markets, okay? And of course when crashes occur, such as the Wall Street crash in 1929, or the subprime lending financial crisis of 2008, it often ricochets throughout the whole real economy, because basically there's a negative net wealth effect, okay, which then leads on probably to a recession, if not a depression. One of the earliest examples is the 1620s tulip boom in Holland, where particularly black tulips were sought after. They went up and up in value, I think to about 1,000 guilders, and I checked that, and then they crashed. We've got the South Sea Bubble of the early 1700s, 1929 Wall Street crash, 2008. There are numerous examples of this herding behaviour. You might say once the general public say you should start getting into shares or buying property, then the taxi driver is telling you this, then you should maybe get a bit worried, because you're heading towards the top of the bubble. Anyhow, this has significant macroeconomic implications, potentially. And this now brings us on to market rigging. Okay, so market rigging is simply when groups of individuals or institutions collude to fix prices or exchange information that will lead to their gain at the expense of others. Dreadful thing to do. So this is often called, examples of this are insider trading. So for example, you're the managing director of the company, and you know it's going to be bad financial news tomorrow announced. What are you going to do today? Sell your shares? That's a good example of insider trading. If you work in a bank and you know, your friend has told you, there's going to be an acquisition of firm A or firm B, what are you going to do? Well, if you buy shares in firm B, you will find that you'll do very well as the share price zooms up, based on that insider information. And LIBOR is a very good example, the LIBOR scandal, of market rigging. There are meant to be rules against this. For example, within banks, the people advising clients of what shares to buy should be separated by so-called Chinese walls from the people advising on mergers and acquisitions. And the combination of those two groups within one bank occurred in London after the 80s Big Bang. Previously they were separated institutionally. Whether it works, well, I'll leave that for you to judge. And this brings us to the sort of final externality of market failure. A negative externality is that the costs borne by firms, individuals and governments are not financial markets themselves, are often very significant. For example, the UK government spent 133 billion after 2008 nationalising UK banks such as RBS after 2008. So there are a significant number of financial market failures, does this mean that we need a light touch regulation or something a bit heavier? Well, that's for the next video. Thank you for watching.